Hello, guys, and welcome to another week of FDN Econ. This week we'll be discussing markets. We'll be discussing about what markets are, how do market economies work, and also, why markets fail and what we can do about that. It's going to be a pretty lengthy discussion. There's a lot of materials for us to go through, so we'll be tackling essentially three main sources of materials. We'll be taking off from broad conceptual discussions taken from Mankiw's Principle of Economics, but at the same time we'll also be tackling two of the readings that we assigned for this week, primarily why markets fail. I'm sorry, how markets fail, and also basic economics. All right, so let's jump right into it. So for today's presentation, we'll be talking about five different things. We'll be starting off with a discussion on markets and prices. Then we'll be diving deeper into the power of prices and understanding that within a broader, consumer market. Then after that, we'll be discussing competition and why that's important in market economies, and what happens when there isn't competition or when competition is constrained. After that, we'll be talking about market failures and what happens during market failures and why it happens. And we'll be ending up our discussion with a call for regulation, understanding where government comes in. Now, we won't really tackle the full complexities of the notion of regulation just yet. We'll be tackling this by the next session once we go into government intervention. All right, so let's jump right into it. So any discussion about market economies and the market in general needs to come from a discussion on economic systems. Now, throughout the history of mankind, there has been multiple types of economic systems, all throughout the years. And a lot of that is really driven by these more primitive pre-industrial economic systems driven by the type of societies that drive them. So, when you think about tribal economies and the barter and trade system, and also like thinking about the feudal system where we have a serf, a lord, and vassals or serfs who work for them. And all of these different economic interactions somewhat shape the way we understand economics nowadays. Now, in the latter part of the 1980s, sorry, the 1800s to about the 1900s, there has been a fair bit of work done in trying to understand a better way of organizing our system. And an important seminal work that was created during that time was the, uh, the Wealth of Nations written by Adam Smith. Here he discusses a free market system that talks about an economy unencumbered by government intervention. Now we need to appreciate that these concepts rather, are driven by the contexts of their time. So when you think about capitalism in the context of Adam Smith, you're talking about essentially a society that has merchants who drive the middle class, who drive the local economy, being taken advantage of by the lords and the general monarchy and the aristocracy that govern the local systems at that time, and use the wealth of merchants to forward their wars, right, or to finance their wars. And that's an important sort of jumping off point in trying to understand the criticisms of government intervention back in the day. Because we have to understand that government, as how they understood it, is not the government we know today. And that democracy as a system hasn't really fully formed or hasn't really, fully matured. Not to say that it's mature now. Um, but the main crux of that argument is really driven by a fear that a small group of people would have an immense amount of power to control over how the economy would work. And that's a genuine fear. That's something that we don't necessarily want, right? Especially with the expectation that these people would work towards their own self-interest, which was particularly true of the time. And from sort of these primary notions on the free market system, there were important steps taken to sort of understand it within a broader context of capitalism. Capitalism, for the most part, is that theory pushed forward, right? The understanding that, well, if individuals act on their own self-interest, unencumbered by government intervention or any type of intervention at that, then you will stand to arrive at a truer representation of the actual needs of the population. Now, it's a novel notion to start off with because it's a powerful notion to come off of, right? But at the same time, there's a fair bit of uncertainty and a fair bit of discomfort with that notion because we see that, well, in a lot of cases, as how economies matured, yes, production was generally better. Yes, consumption was driven up, but in general, people aren't necessarily better off, right? So while wealth is being created as a whole, not everybody participates in consuming that wealth, right? So there's a fair bit of inequality um, between people who own capital and people who don't. In the latter parts of the 1990s, um, and sort of the early parts of the 1980s, there have been multiple movements that sort of drive an alternative narrative. And the going argument there is that, well, in as much as it's problematic for aristocrats and monarchs to take advantage of merchants back in the day, it's equally problematic to have large business folk and people who own capital to sort of maximize and capitalize on the labor of laborers, the labor of the working class. So because of that, there was this resurgence of the argument for going back to central planning. The natural folly of market systems that tend to fail in these types of environments. Because of that, when we're thinking about the modern criticisms to the market economy, it's really driven by this alternative proposition for centralized planning. Now, um, while there is an important point to push forward in terms of valuing, a more ethical, a more equitable distribution of wealth, and a more ethical design for the economy, central planning really doesn't work for the entire market, right? There are a lot of things that an individual cannot plan for, and push comes to shove, that's what a government is, right? It's a set of individuals making decisions for everybody else. So there is now an alternative being pushed forward, and it has been an alternative that has gained some traction over the past 2 or 3 decades. The idea of setting up a mixed economy, right? The idea of having both a market and some form of government regulation, redistribution, and a sense of shared or community ownership. And these notions are pretty important in the broader arguments being put forth, in so much as how we need to really understand how our economies are driven. Now, at the root of it all, though, is that there is still an importance for the market because the market allows us access to understand how interactions between different individuals, between producers and consumers, transpire in the real world. Um, and we'll sort of dive deeper into that as we move along. Now, push comes to shove, like when we think about the free market system, it's really driven by the underlying assumption that within a free market capitalist system, you have distributed decision making. That's its main selling point, right? Wherein which careers you decide to pursue, which products or to produce or buy, when to start and shut down a business, and who gets what, are determined by our own individual agencies, right? So we determine what we want to do, and the trends that we see and how we react to those trends are driven by our own individual decisions. It's not, let's say, one government deciding what careers need to be prioritized over others. It's not, one entity telling you that this is the only product you need to create, and these are the only things that you can buy, right? So that's it's sort of a main selling point as a system, its main characteristic as a system. And there are multiple advantages to that, right? So first and foremost, decision makers are closer to information. And what I mean by that is, say, imagine you want to paint a house, and it's your house. You know what colors you'd want your walls to be. So, when you go to a paint store and determine, which paint would I buy, you'd know which paint to buy, right? And which color to buy it in. But let's say if you're a city planner and you are put in charge with deciding the houses for 100,000 people, right? There's no way for you as an individual to know what the specific color preferences of each individual is living in those houses. You can take a survey, you can understand what majority of them want, and make a decision from that, but that is still not driven by the actual demand of the population. Compare that to, let's say you have a marketplace where anybody within your city can buy a paint, right, and determine what color of paint they want to paint their houses in, then it will be much closer to actual demand, right? So there's a certain value to that because, you don't necessarily distort people's choices. Second is that there is a powerful incentive to get things right. So when you think about a free market economy, the better you perform, the more able you are to understand the actual demands of a given market. If you know what people actually want, then you get access to a larger share of that market, right? You sell more and you earn more. So that in itself is a powerful incentive in terms of driving up innovation, driving up efficiency, and generally making things better. Lastly, there's this notion of freedom of choice, and there's a certain novelty to that as well. Wherein in a free market system, you choose which products you want to buy. Now, there are some really powerful assumptions coming out from the opposite end here, right? Especially for the freedom of choice, right? There's an understanding that you as an individual understand the nature of your choices, and you make your choices after comparing and ranking all other available choices to you, which is something that most of us don't necessarily do. So, when we try to understand the free market system, it does come with these certain rules that have to apply in order for it to work. And any criticisms that we put forward at this point on needs to arrive at that clear understanding. All right. So, in a free market system, there are also a ton of disadvantages to consider. First, it's not always efficient. More often than not, when you think about, um, you know, Grab and Uber in the Philippines, when Uber left, Grab prices suddenly started to skyrocket, right? So this is a situation wherein you essentially created a monopoly in the transport industry. Um, so when we think about a free market system, when there is a natural tendency for winners to edge out other potential competitors to enter the market, especially in industries where there's a high fixed cost, no, to participate, then that actually drives inefficiency rather than correcting it, right? So which is counterintuitive in a free market system. More often than not, they have to rely on regulation to correct these situations. Second, it's not always equitable. So this is actually the main criticism when it comes to capitalism as an economic design, right? Wherein winners tend to share a much larger piece of the pie than everybody else, and there's a fundamental sort of misunderstanding about the role of labor and how to fairly compensate labor in relation to profits and earnings of giant firms. So one way by which this is corrected, given neoclassical economics, is the notion of redistribution. The idea of through taxes or through other means, no? Even through things like corporate social responsibility activities and so on, that we are able to redistribute resources from those who were able to earn more from the system to those who were not able to earn sufficiently from that system, or for those who need that extra bit of support. Um, why is equality or equity important? Well, at the root of it, in a free market system, you need people to be able to buy things, right? And if inequality is driven to a point wherein you have way too many people who don't have a whole lot of money to spend, then your whole consumer market will crumble. Nobody would be able to buy products in the first place. So in principle, the whole sort of system stops. So there's a certain value to maintaining equity, especially in free market systems. All right. So in trying to understand markets, there are a few things that we need to understand. One, within a market, most of the exchanges that you participate in are largely impersonal. Meaning to say, when we think about the relationships within markets, it's not really driven by factors outside what you need or what you want and what you're willing to pay for, if that makes sense. So it's a very utilitarian exchange. Second is that everybody in the market is both a seller and a buyer to a certain extent. Everybody participates in the production of goods, um, and everybody participates in the consumption of those goods, right? So the worker um, is also the consumer in that sense of the word. And the firms, in as much as they produce the goods, they're also consumers of those goods. And the last two things is that, one, there are certain rules that apply within markets, and abiding by these rules are essential for it to work. And that lastly, it's an arena. So it's a space by which people engage in, right? Rather than just an arbitrary concept that encapsulates the complexities of human interaction within the economy. So it's important to understand markets within these contexts as it drives a broader understanding of the type of relationships we're assuming people would have within the space. All right. So now we're jumping into Basic Economics by Salo. This is one of the readings that I required you guys to read, and some important questions being raised in the article, um, where what determines prices in markets? Is it the cost of production, the willingness to pay rather, or supply and demand, right? As how neoclassical economists framed it since the 1870s rather. So there's an underlying question, right, between the relationships between markets and prices that we need to reconcile. Now, when we're thinking about markets, we can't sort of separate it from the fundamental notion of prices. Now, imagine a world without prices, right? So let's remove the notion of things costing money or things costing something, and think of a world where you're able to access something solely because you need it, right? So, if you need bread, you just get bread. And the value of that bread is constitutive to what your needs are, right? So this is essentially the design of central planning. You rationalize production based on the assumed demand of the population as determined by a small set of individuals making those decisions for the entire country. Now, there is a fundamental problem with that notion, wherein in the process of engaging with a group of individuals and understanding a set of needs they have, those needs mature over time and they vary, right? And in the process of responding to those needs, markets tend to respond faster than central planners could ever hope to respond. No? So imagine, at the start of the pandemic of this year, right? If we only had central planners determining the amount of face shields we're going to make in any given year, then a central planner would determine the amount of face shields we would need this year based on last year's demand, right? Because you can't really foretell whether or not you'll have a pandemic this year or not. Um, so if we only produce based on what we could expect next year, then shortages over a long period of time will be inevitable. And the only time for a central planner to come in and determine, okay, we need extra, face shields. How do we mobilize that? You know, do we need to set up an additional factory? How do we do that with social distancing as a component? How many hours? How many people do we need to hire? Where do we source the cloth and the thread and all of these other aspects of logistics that you need to figure out. Not even thinking about supply chain. There's a lot of things to consider in order for that to work, right? And there will always be a delay. But considering that same experience within a market economy, we see that people as individuals started to respond individually. What we found was that designers who couldn't design dresses anymore with demand being so low at the start of the year started to make face masks and started to give it away, right, to frontline workers, eventually selling it, right. So we essentially saw, a surge of individuals who started to, through their own enterprising ability, started to create masks and sell them online. And suddenly the market started to normalize. Prices started to go down again. There were really like ridiculous prices at the start of the pandemic. Like they were selling, 60 pesos per disposable mask at the start of the pandemic. But now, you can access a fairly cheap mask at a fraction of the cost. No, it's not as low as what it was prior to the pandemic, which is to be expected, right? There's an uptick in demand, so you can't really pull that down too much. But there's a market correcting activity that was undertaken, no? Because the market essentially responded to the sudden increase in demand. And you can't expect that same agility with central planners, unfortunately. Um, Also, bureaucracies can do productive work elsewhere in the economy. When you think about the roles that government has to play, there's a ton of things that government normally has to do. They have to think about, regulation. They have to think about social planning. They have to think about, producing um, managing banks, right? Producing providers of healthcare, at different provinces and municipalities around the country. So there's a ton of things for government to wrap its head around, um, outside of determining what products to produce, at which price to sell it for, and to whom they should sell it to, right? So by utilizing prices as a way to organize, the complexities of those arrangements, you actually find a simpler mechanism that can do the same job faster, cheaper, and better. And this is the main power that prices have. Now let's look at an example. So like when we think about the Chinese consumer market, we need to understand that China has 1/5 of the total population of the world. It only has about 10% of the world's arable land, right? So this, on the onset, shows us a critical problem when it comes to food security, right? Within a closed economy, they would have to rely on what arable land is available to them in order to produce the sheer volume of food they need to feed their entire population. So, at the start of China's the Communist Revolution in China, there were recurring famines that took the lives of millions of Chinese people back in the day. Now, we have to understand that by engaging in trade, you can actually capitalize on the overproduction of goods in other countries, right? So, given the attractive power of prices, certain companies, as in this example, KFC, no, which is a fried chicken company in the United States, saw the huge potential of the consumer market in China, and went there, no, to sell their chicken when China started to open their markets. Wherein by the early 21st century, um, they were making more sales in China than in the United States, right? So China's per capita consumption of dairy products nearly doubled in just 5 years, and that recent data shows that 1/4 of adults in China are overweight, right? It's not necessarily the best statistic to start off of, but that's an important indicator. It's essentially saying that food now is more accessible to China within a market economy than what it would have been, a few years back when they had a closed economy that was driven by, a centralized planning system. So there's an important point to come off of here, wherein if we want to understand the power of prices, we need to only look at experiences in history, and how utilizing prices correctly, leveraging off of the power of prices in order to create more efficient markets, becomes an essential component to how these interactions will mature over time. All right. So at the core of all right. So when we're talking about market economies, it's inevitable for us to touch into the notion of supply and demand. And in understanding supply and demand, obviously you have two main concepts to work through. You have supply and demand, right? So supply is largely represented through a supply curve. It is the quantities of goods sellers wish to sell at each price. So as prices rise, vendors want to sell more, right? So each firm wants to sell more, and more firms would want to enter the market. Um, this is why the supply curve is essentially sloping upward. So this is actually a really good visual representation of how that relationship works. If you look at, you know, um, at about $2 per slice, you essentially produce 8,000 slices per day. And as price increases, the number of slices, the quantity of slices also increases. So at $4 per slice, this essentially means that more firms would like to enter the market, or firms who are already in the market would end up trying to produce more to capitalize on that demand, in that higher price, and therefore they would be producing 16,000 slices per day, right? So that's the supply curve. Now, the best way to explain the supply curve is, by looking at the notion of how higher prices allow goods with higher opportunity costs to be produced and brought to the market, right? So the best way to illustrate this is by, imagine the entire market is food market is composed by uh, two providers, right? You have a pizza shop and, let's say, an ice cream parlor, right? So the pizza shop owns about 50,000 pesos net of tax every month, while the ice cream shop earns 70,000 pesos, um, net of tax every month, right? So in the current market, the ice cream shop is perfectly happy just selling ice cream. The pizza shop is maybe earning enough that there's no real incentive to try to jump ship and start selling ice cream, right? But what if the prices of pizza doubles, right? So instead of earning just 50,000 a month, prices were doubled, so therefore he was earning about 100,000 per month. It's a pretty significant jump in income. Then the guy owning the ice cream shop may start considering selling pizza, right? Making the investment to buy that oven, get a chef, set up shop, right? And eventually start selling pizza in order to capitalize on the higher prices. So the ice cream shop may eventually decide to sell pizza. If the price of pizza triples or quadruples over time, they may decide to jump ship and just purely sell pizza instead, right? Because the opportunity cost now, which is much higher at a much lower price, has now diminished. No? And it's more profitable for the ice cream shop to actually shift to become a pizza uh, parlor, no? Instead of an ice cream parlor, um, and because of the higher prices. Right? So that's essentially how supply is envisioned to work. The second notion that we need to discuss is the notion of demand, as represented by the demand curve. Now, demand refers to the quantities of goods buyers wish to buy at each price. So, as price falls, consumers want to buy more. Either each person buys more of the same good, or more people now start to enter the market. So, demand curve is essentially downward sloping. So you can see through this graph how that works out. No? So as price decreases, the quantity of goods being sold within the market increases, right? And this notion is quite intuitive. No? As price falls, if there's something that you really want and suddenly goes on sale, then you are more likely to buy it, right? Uh, but in certain cases, if you have an excess amount of money, it doesn't really matter what the price is. If you want it, you'll buy it. So what that essentially shows is that people who have higher income will have a propensity to buy that particular good. But as that price decreases when it goes on sale, people who can't afford the original price or who may not be willing to pay it for the original price will now come into the market and buy that product, at a much lower price. So that's essentially how we see demand working. The main explanation here is something that we've already tackled in this class about 2 weeks ago, the notion of the law of demand, right? So you see both here the substitution effect, which we've extensively discussed, wherein, you know, uh, in certain goods, as the price increases, you have a tendency to substitute it to the next best product, no? Or a comparable product. And you'll also have the income effect, wherein as price decreases, people become relatively richer, and therefore that changes their consumption behavior. Right? So they either buy more, they consume more, or they start to consume something else instead. So that's the main sort of notions that we have to work with in understanding markets. Now, at the root of both demand and supply, we have to also talk about the notion of equilibrium. And equilibrium refers to um, when there is no tendency for it to change. Right? So this is where both demand and supply meet, uh, wherein both consumers are happy with the quantity being produced and at the price it's being produced at or it's being sold at, and producers are willing to produce at the price it's being sold at. So market equilibrium refers to when all buyers and sellers are satisfied with the quantities consumed or sold. So here we see that in action. We see the point where demand and supply meet, and we see it at about $3. So at $3, um, people are generally happy at that price, um, being sold at a quantity of 12,000 slices per day, right? So producers aren't losing out, meaning they're not selling it at a loss. At the same time, uh, a fair amount of people can still afford the commodity. No? Obviously, there are still people who won't be able to access that commodity at that price, um, but that's sort of how the balance works, right? Inevitably, there's a certain limit to how much products you can actually produce, at the cost by which you're producing it. So there's a natural limit to that that we have to consider. Now, when we're thinking about markets and prices, the most important aspect to price is that it has the ability to capture and reflect scarcity. So, like I mentioned earlier, there are not enough resources to go around. Even if we're thinking about universal rights and universal entitlements, all of these things have cost. And up to a point, there are certain times wherein producers aren't able and willing to pay that cost anymore. Prices are like messengers, no, conveying results, no? Which is to a certain extent a product of our own decision making. So when we look at the price, it's not necessarily just set by one individual, but rather it is set by our collective perceived value of that commodity and the producer reacting to that collective perception. So the producer is assuming that this is the value that people are willing to buy my product for. No? Um, and this is the price now that the producer is willing to set relative to the cost of actually producing the product, with profit in mind. Um, Now, prices are also able to provide financial incentives, and this is an important notion to jump off of, right? It's able to affect behavior in the use of resources and their resulting products. Now, when we think about a free market system, oftentimes it's associated as a profit system. And to a certain extent, it is, right? Profit is an important component to how the psychology of this market economy would work. But in truth, it's actually a profit and loss system. Losses are just as important a notion in understanding a free market system. Because losses now tells a provider when to stop. So once they start losing out in the process of producing a particular product, it sends them a signal to say that you probably shouldn't produce that product anymore, right? So a crucial component to understanding market economies is the notion of competition. So competition in the market is what limits how much anyone can charge and still make sales. So there is this underlying question, that if we allow markets to freely operate without any type of restrictions, what stops a provider from charging the absolute maximum, no, especially for a commodity that everybody needs. With competition, there's a way for self-regulation in that context, wherein because there are multiple players in the market and everybody's trying to maximize their market share, the tendency is actually to depress prices up to the barest minimum in order for them to offer the best price to the consumer market and maximize their total sales. No? But again, that's within a context, assuming that competition is an inherent component of that market economy. Later on, no, as we progress and explore further the notion of market economies, we understand that there are certain times wherein competition becomes imperfect. And more so, we're in times where competition totally breaks down. And in those cases, the normal assumptions about how market economies work and the advantage of market economies don't necessarily apply anymore. Now, from this standpoint of the economy as a whole, this means that resources tend to incrementally flow to their most valued uses, no? Where the price competition, or rather where there is price competition in the marketplace. So this is, again, sort of playing off of that crucial notion wherein the market somewhat regulates itself. No? That there's a way for it to rationally arrive at the most equitable, or rather the most efficient allocation of resources. So a good example of this is thinking about milk, no? And how milk, which is valuable to ice cream consumers or consumers of yogurt, as it is to cheese purchasers, will be used to make ice cream or yogurt. So production in principle aids the production of other goods and commodities. And the production of other goods and commodities is largely dependent on demand, or the share of how much people are willing to pay for the commodities being offered to them. So if we allow prices to coordinate the economy, you essentially allow it to self-rationalize, and in that process, through price coordination, you do not flood people with commodities that would otherwise remain unused, no? Or at least the barest minimum. That's the assumption. Um, you only, in essence, produce a certain good in so much as there is demand for it, and you'll stop producing once people are sick of that good. Going back to our earlier example, people will continue to produce cheese up to a point where people are sick of it, while others are looking for other dairy products, either ice cream or yogurt. So it's this precarious balance and trying to capture demand, actual demand, relative to what is being produced at what price. Of course, there are intricacies to that argument, especially if we're thinking about the real economy. Obviously, there are issues around sticky prices, so demand doesn't necessarily allow for an immediate shift um, in terms of supply. So it doesn't mean that if there's a rapidly increasing demand for a particular good, that automatically producers can catch up to that demand at the same pace. More often than not, there's a certain delay. More so, when prices increase or decrease, people don't necessarily respond as immediately. So, let's say the price of a commodity suddenly decreases, while theory will tell you that people will automatically either buy more of that good or more people will start buying that good. There will be a period of delay between the people actually wanting to purchase that good versus the people who don't. So the important point being delivered here is that competition now becomes necessary for prices to work effectively. Because prices are supposed to signal the collective wisdom of all the players within that economy. Once competition starts to break down, then prices don't necessarily reflect the actual demand of the population. Now, in trying to contextualize market economies, it undergoes a principal assessment built on the following hypothesis, no? Called the efficient markets hypothesis. In here, the assumptions are pretty simple. That current prices incorporates all relevant and available information, meaning to say, things like pollution, uh, the environmental impacts of the production of certain commodities are already reflected in the price of a particular commodity. Second, new information on expected future profits are reflected in the prices, and prices change very fast. No? So the assumption here, excuse me, is that um, as new information comes in, prices rapidly adjust relative to that new information. Third, otherwise slow change at the rate of discount. So what this essentially means is that um, the process by which a particular commodity is discounted isn't rapid, isn't immediate. Uh, One thing to note is that EMH hypothesizes optimal forecasting, not necessarily perfect pricing, which essentially says that there's an ability to predict where the market is going and where the prices will land. Um, but however, the assumption here is that you don't you're not expected to know exactly what the prices are at any moment in time. There's still a fair bit of space for those forecasts to be wrong. Now, another aspect of the efficient market hypothesis is that you can profit from publicly available info. So the assumption here is that since information is available to everyone, that information by design does not give anybody a particular advantage. Another implication is that no one can beat the market except for insider traders. So the main control requirement for the efficient markets hypothesis to work is that insider traders are controlled for. And that if there are individuals who capitalize on a particular market outside the normal expectations of how that market will play out, or how that particular industry or firm will play out, then the expectation is that it must be because of information that would otherwise be unavailable to the general public. Um, Third is that profits come from frictional trading as new information is integrated. So it's not about information that is not generally known to the public but is already there, but rather, profits are driven by new information as it comes in, and people capitalizing on that new information in order to make certain decisions about how that industry will grow. So a good example of this is the price of the Goodman Group before and after the Botany Bay zoning. So it's a particular real estate area in Australia. And the idea here is that, when they bought the property, it was really, really cheap. But because of the zoning changes done by the government, those properties were appraised at a much higher price, allowing them to access more profit. Right? Another interesting example here is Bitcoin. So if anybody trades in Bitcoin, this is an important sort of jumping off point for us to understand efficient markets. So with Bitcoin, the value appraises as more and more people assign or ascribe higher value to it. So the information that drives the value of Bitcoin is really somewhat anchored on this speculative pricing, and the expected value of Bitcoin as it pushes forward. So if you do profit from Bitcoin, it's because, when it came out as a new form of currency, the people who are now, earning a lot out of it are people who saw the value and took the risk, as new information is integrated to the financial markets. So it's a gamble, and they ended up winning that gamble. Now, in any market economy, the goal is, to hit market equilibrium as it represents the most efficient allocation of resources. So markets will only be efficient when buyers and sellers are well informed. So everybody knows the parameters by which, economic decisions are being made, and that the prices reflect the real costs of producing a particular good. Second, that buyers and sellers are behaving rationally, so they make decisions relative to what affords them the most utility. Third, that markets are perfectly competitive, meaning to say there is no one provider that has extensive control over the market in terms of pricing, and at the same time, there's no one consumer that has extensive control over the market. So that's either monopoly or monopsony. That also means as well that supply measures all relevant costs, demand measures all relevant benefits. So whatever you get out of a particular commodity, and whatever costs you paid in order to produce that commodity are reflected in the price. And this is where it sort of gets difficult when we're looking at real production. There is also no inefficient interventions in the market, and this is an important point to consider. When we think about government interventions, more often than not, the assumption is that it drives certain inefficiencies in the market. To a certain extent, that may be true, and these are trade-offs that government has to make in the process of how it's designing its economy. Um, there is an argument to be made for, let's say, imposing tariffs, or imposing certain types of taxation, and sort of the social benefits can be juxtaposed to the economic losses um, with imposing these types of rules. No? There's a redistributive quality to imposing taxes that can have extraneous value um, to both the citizens of that country as well as to the government as a whole. That said, there are certain types of interventions that governments often use that can make the market inefficient. And these are things that, for market equilibrium to be achieved and for efficiency to be achieved, needs to be avoided. In considering all of the implications and the assumptions of how efficient markets should work, we need to juxtapose these theories relative to the realities that we face, especially in trying to understand economics uh, in an applied sense. No? And if we look at reality, we see that certain aspects of the theory don't necessarily hold water. It's not to say that there's no value to the theory in and of itself. There are multiple ways to appreciate theory, whether they to see it as an accurate reflection of reality versus an aspirational um, uh, goal, no? um, as to where the government or its people would want to direct um, uh, you know their economic design to move towards. Um, but all of these aside, the bottom line is that when we look at real markets, when we look at reality, there are certain issues that we cannot avoid. And these issues bring forth important points to consider with how we organize our economy. First, there are many market anomalies that we can see. So things like monopsony, oligopolies, monopolies, these exist in the markets, which can then lead to market failures. There's high volatility in certain markets. Momentum is something that we need to consider in terms of understanding how these markets evolve. Um, there's lots of movements on known news. So like when these are all driven by irrational speculation um, that is not necessarily based on clear indication of where the market is going. And prices don't fully adjust instantaneously. So as I mentioned earlier on, there is a notion of sticky prices. So um, there's a certain lag or delay as new information comes in. So because of these realities, it's important for us to understand that, well, while imperfect markets exist, uh, there are certain advantages to market economies that we need to consider. But at the same time, there is an important need for us to rationalize the general direction of where we're carrying our economies, and that governments and firms do play an active role in shaping these interventions. Now, more often than not, um, a lot of the times there are certain groups, particularly private firms and private individuals, who ends up being able to beat the market. Uh, so these are investors who have special information, special skills, or human capital, invest time and effort, bear more risk, and where market power can work for or against investors. So the idea here is to limit the adverse effects, and to limit you know, um, unintended or uh, unwanted control in the markets, specifically for firms, no? Who stand to gain the most out of that arrangement. There are certain things that you can't really control for. So things like special skills and human capital, these are things that people can invest in and can find genuine advantages for in terms of growing their business. Um, but you know, price setting powers for certain monopolies and monopolies, or collusion between uh, different companies, or when you think about how cartels work in terms of price setting for oil or any other sort of special commodities. it's important for us to make ways to manage these types of market failures. And here is where it becomes essential. The way we sort of figure out regulation within that broader framework. Now, a market failure is simply when free markets fail to result in an efficient outcome. So the general assumption is that if you leave a market to operate without intervention, it should arrive at the most efficient outcome. But there are many times wherein that doesn't happen. And what it creates is what we call externalities. Now, there are two types of externalities. There's external cost and external benefits. External costs are essentially negative externalities. External benefits are positive externalities. External costs are the costs falling on third parties without compensation. So essentially, this is a cost that everybody pays in accessing a particular good that is not really compensated for. No? So one really good example of this is pollution. So like when you think about older factories, the automobile industry, a lot of the appliance industries for the past 2, 3, 4 decades, they had certain practices which increased carbon emissions, resulted in the creation of uh, CFCs that started to eat at the ozone layer, right? And that had huge effects in terms of ecology. That had effects on the quality of life of people. That had effects on the ability of certain people to work, especially if it had specific health issues. So one really good example would be Australia and sort of the increased risk for cancer, skin cancer in Australia because of the whole of the ozone layer in their general area. No? And the, those things carry with them certain costs that people pay for because those products were produced. And those products, when they were produced and they were sold to people to consume, uh, the cost, the environmental cost of the pollution created was not reflected in the sale cost. So, in essence, the people who are paying for these external costs are not the people who benefited from owning an automobile in the 1970s, 1980s, or people who own you know old style refrigerators of the 1990s. So the idea here is trying to correct for those costs, and we'll discuss that in more detail in the next class. Another type of externality, and this is the type of externalities we want, are external benefits. So these are benefits received by a third party without compensating the originator. So some really good examples of these are honeybees, R&D, or urban agglomeration. So, like when you think about honeybees, people who cultivate honey through honeybees essentially do it for the sake of collecting honey and then selling, the byproduct of honeybees to the public for consumption. But there's an external value to cultivating honeybees, right? They're an endangered species and that they're essential for the pollination of flowers. So those the benefits we get out of the people who cultivate honeybees are things that are not reflected in the price sold. But everybody benefits from that arrangement. Uh, Same thing with R&D. So like when we think about investing in research and development, um, more often than not, it's to create a particular commodity. Let's say if you're creating medication or a particular treatment, but that can have actually multiple. Once you create a drug, that can have multiple uses. And those additional uses discovered in the process of investing in R&D uh, are benefits that we get out of that process that we didn't necessarily pay for. Because more often than not, the cost of the R&D is proposal to identify a particular use, and it is paid for that purpose. So we get more value in the process of investing in research um, than what is intended to be paid for by that arrangement. Now, in appreciating market failures, though, there's an important question that we need to answer, and that is, why do markets fail, and how do markets fail? And Cassidy actually breaks this down quite efficiently in the book. Um, Cassidy references this notion of utopian economics, which is the widespread view that the self-interest of individuals and agencies, um, allowed to express itself by a free market economy, will inevitably produce results that are good for the whole economy. And this is, for him, a rather problematic notion with how we appreciate current markets. Um, the underlying ethic of this notion is that if everybody acts on their own self-interest, that pushes our collective interests forward. And to a certain extent, in a world wherein no one individual has more control or more power than everybody else, then that can be true, right? That can be possible. Um, because if there are no power dynamics across individuals, then the individual interests of each person is valued equally. But in reality, there are significant power dynamics that define the social arrangements that we have as a society. And those power dynamics, in effect, um, determine which interests are weighed at a much higher value than other individuals. And here is where that theory somewhat um, falls off. No? And that's sort of the point that Cassidy is arriving at. Now, Cassidy puts forward four illusions of utopian economics. The illusion of harmony, wherein free markets always generate good outcomes. The illusion of stability, that free market economy is sturdy. The illusion of predictability, that distribution of returns can be foreseen. And the illusion of the homo economicus, that individuals are rational and act on perfect information. All throughout the semester, we've realized that there are certain aspects of the free market economy that don't necessarily fall in these four assumptions. So when we think about free markets and how it influence um, climate change in general, we can see that there can be in fact negative externalities that the free market can create. That imperfect pricing can lead to the production of certain goods and the sale of certain goods that don't necessarily reflect the entirety of the cost in producing that good, and that this disenfranchises some people more than others, right? So when we think about climate change, in truth, the most affected populations are the really vulnerable populations in Pacific Islands, where their islands are likely to disappear if water levels continue to rise. Um, they're paying that cost uh, because people 30, 40 years ago in more developed nations wanted to have certain conveniences like cars and appliances. Right? Um, so that's sort of where that fundamental problem lies. When we think about the illusion of stability, um, the history of free market economics is actually a series of booms and busts, right? So right now, the Philippines recently underwent a recession following the pandemic. It wasn't, you know, it wasn't more than a decade ago since we've had our last recession during the housing bubble, where a lot of companies started to lose a lot of money, and that's not the only two significant recessions in Philippine history. There was the Asian financial crisis. There's the global recession um, following, the depression in the United States. So, um, the history of the free market economy is actually riddled by these booms and busts. Even industries of particular importance is the housing bubble in 2008 to 2010 is that even industries that are seen to be stable and sturdy, um, because of the lack of regulation in terms of trading these um, speculative instruments. Essentially, these were banks selling out subprime loans to willing buyers so that they can get a significant payoff later on in the future. That essentially, it created a demand to own multiple homes that people can't afford. People can't actually afford. And once that bubble burst, that had a huge effect on the global economy. Even industries that are seen to be pretty stable, like real estate and housing, where values are expected to continuously appraise in general, can be quite uh, volatile if regulation isn't there. Um, in terms of being able to predict or foresee returns, um, in truth, most of the time people fail at properly forecasting results. Right, people get it wrong more than they actually get it right. So the illusion of predictability is something difficult to grapple with because like a huge work of a lot of economists and people working in finance is in the field of forecasting, trying to understand what the effects are in the future. Um, but your ability to forecast is just as good as the data that's available to you, and more often than not, the data isn't um, an accurate picture of some of the realities you have to deal with. So you don't really get the ability to fully predict. The last illusion is something that we've already somewhat tackled in earlier sections of this term, wherein individuals actually aren't rational, right? Or at least rationality is something that's not universal. To a certain extent, people make irrational decisions, um, and that the way forward for economics is actually accounting for that irrationality um, rather than expecting it and expecting people to have perfect information. So those are important like problems that we have to grapple with as scholars engaged in the field of economics. Um, and that the way forward to a certain extent is to understand that these assumptions don't necessarily hold a whole lot of water, and that we need to push forward the discipline in order to better account for the uncertainties and the discrepancies that we observe from the predominant theory that is being applied. Now, at the end of it, if the problem is a lack of information or problems with overconfidence or issues with firms who abuse their positions, then the solution would be fairly easy, right? The assumption there is that well, greed can be something that we can control, overconfidence can be punctured, and even stupid people can be educated. The traditional assumptions here is that if we can find a way to manage the greed of certain firms, that you know we find a way to make people more cautious and temper their expectations in terms of how or where the economy is going, and if we make an effort to make information known or accessible at the very least to majority of the population, then that fixes the problem. But in truth, it really doesn't, because fundamentally, what at least what Cassidy puts forward is that the real cause of the crisis is far less amenable to reform. That it sort of reflects back to the inner logic of the economy that we currently have. Right. So the root of the problem is what we call rational irrationality, behavior that on the individual level is perfectly reasonable, but when you aggregate it to the marketplace, it doesn't really reflect reality. Right? It creates calamity. Okay, so the broader challenge in terms of appreciating markets is understanding that, well, on the one end, there is an important requirement for us to control um, for the things that we can control. But another aspect of it is for us to reevaluate our expectations about how the market works, and for us to adjust accordingly. The fundamental challenge there is, what can actually be done. And Cassidy, in his book, proposes multiple things. No? But it all, outside sort of the specific um, positions that he puts forward in terms of, how do you manage um, the housing market, how do you manage banking, and so on. The fundamental assumption here is that there is a need and a space for regulation. Um, the role of government, from where it was in the 1970s, and sort of the expectation of the government as an important component in driving where the economy is going, has taken a fair bit of resurgence in recent years. Um, the idea of big government dictating, how firms need to behave, and how businesses need to be developed and pushed forward, were largely criticized, especially during uh, the 1980s, 1990s, where there was a fairly conservative growth, no? Especially in the US and the UK, driving for a lesser government. And we see the results of that nowadays. It's not to say that the criticism of government intervention isn't justified, right? There was an important problem to consider between, the wage price spiral driven by sort of Keynesian expectations about how the economy is supposed to function. Um, those criticisms are relevant, and these are things that we will discuss as the term progresses. Um, but outside of that, outside of those expectations, we need to understand that um, governments are there to protect the interests of people. And you need that regulating force in order to ensure that the people who have certain advantages and certain powers don't abuse those powers to put forward their own interests over everybody else. So uh, that's an important consideration with how we're framing this broader debate. And that's actually a really important segue to where we are going next meeting. Um, so, if markets by design can be imperfect, and that there is a possibility for markets to fail, then we need to resituate what the role of government is in all of these arrangements, and how they can make it better for individuals in the long run. How do they make competition more well competitive, or more how can they make more individuals participate uh, in production and consumption in the economy, um, and how do they ensure that no one individual um, supersedes the interests of everybody else. Um, so yeah, we're ending the lecture there. These are important questions for you guys to reflect on in terms of how you would approach government intervention in the next class. So yeah, all right. Uh, I'll end it with that, and I'll see you guys next meeting. So with that, we've just finished our section on markets. Next week, we will be having government, no, not next week, sorry. This Wednesday, we will be having government intervention. I'm hoping that the next group will be ready to report. Again, just focus on, really trying to grapple with the text and trying to understand it relative to, the theories that we're trying to cover. We'll be handling this class next Wednesday, similar to how we handled um, the class on incentives, where we'll have a short lecture at the start of the class looking towards the different ways for government to intervene, which ones are uh, the best ways to handle certain situations, when is it justified to do certain actions, and when is it not justified. Um, and then after that, we'll have the reports and then probably a breakaway session after that. All right. So again, see you next session. Bye, guys.